The best stock in China is not Alibaba, it's not Process, it's not Douyu, it's not Qudian, it's another one. And it's actually from the old Chinese economy. In China, there are two economies. This is what we'll talk about today. There's a new economy and there's an old economy. What's the difference between them? In which one of them do you have to invest? Which one of them is the riskier? We'll also talk about investing in China in general, the risk you need to consider, and whether you should invest in China or not. And then I will tell you about this one stock that I have invested in. This is a great company paying me 8% dividend yield annually. This is a company with a PE ratio of 7. The company is trading under its book value today, so it looks like a value stock. And this company has no debt at all. So the risk the company goes bankrupt is zero. So if it is such a great company, which company am I talking about? It's China Mobile. This company, unfortunately, is no longer listed in the United States. It is listed in Hong Kong. I bought the company more than 3 years ago when it was still in the United States, but then it was kicked out because it's partly owned by the Chinese government, and then I had to buy the shares in Hong Kong. I don't know if you have this possibility to do this, but nevertheless, it is an interesting company and I think it is important to talk about it. So let's talk about the two economies of China first. Why do I say it is from the old economy? And what is the difference between the old Chinese economy and the new economy? So the old economy, this is a state capitalist economy. What do I mean by this? All the companies in the old economy, they are partly owned by the Chinese government or have great control from this government. China Mobile is 70% owned by the Chinese government, and even its competitors, China Telecom and China Unicom, are partly owned by the Chinese government. So this is the old economy. It is state capitalist economy. The government has a lot of power in these companies. And you have to know if you're investing in China Mobile or any of the companies in the old economy, you don't have much to say as a shareholder. It's the government there that is taking all the decision. So of course, I know for many people that might seem unethical. Why invest in a communist country? Why invest in a communist government? But it's up to you. For me, I see the same way that Warren Buffett sees it. You have to put the politics apart. If you can make money, you make money. But you need to understand something. Because eventually, more trade, more capitalism, more investment, this leads to better things. So maybe in the short term, you're seeing it investing in something bad. But over the long term, I think this leads to better things. Because if you move away, if you go away from these investments, of course, the country will close itself more like it's happening with Russia. But Russia, this is another story. And I would advise you to invest. But China, it's a little different. Yes, in recent years, it seems things are getting worse there, but over the long term, I believe things will improve, not just in China, but all over the world. So it's up to you whether you want to invest or not. So what about the new economy? The new economy is an entrepreneurial capitalist economy. It's just like in the United States, United Kingdom, Israel. And there you have these companies such as Tencent, you have Alibaba, you have Qudian, Douyu. I won't call them smaller companies, but companies that are not owned by the government. Of course, now the government wants more control on some of these companies, but initially these companies did not originate from the government. So they were built like any company that you may think in the United States. So by entrepreneurs. That's why it's called entrepreneurial capitalist economy. We have two more types of economies, but they are not really. In China, we have also oligarchic capitalism. This we can see in Russia, in the Middle East. And we have big firm capitalism. This we see in continental Europe, for example, in Germany. It's always a big firm. The same firms that were leading the market there 50 years ago, they're still here. We won't be talking about this today. Let's focus on China. So we have the new economy and the old economy. In which one of them do you have to invest? It's up to you. According to Redalion, you need exposure to both of them. The reason why we call it a new and old economy is because they are very different from each other. In the United States, you cannot really say that a company such as Lockheed Martin, this is a state-owned company. It's not the case, even though most of the revenues come from the government. We cannot say this. So it's purely entrepreneurial capitalist economy. But in China, there are really two economies. And if you want to have exposure to China, you need to have exposure to both of them. The new economy is riskier because these new companies, they don't have that government control. The Chinese government, they are very careful with their money. most of the time. And you will see that most of these companies that they have built, they are companies that have been established for decades. So the risk of these companies going bankrupt, most of them don't even have any debt. So the risk of them going bankrupt is near to zero. Of course, the returns then are going to be less. But you also don't have to fear that the government will have anything bad to do to interfere in the company, because they have already interfered. They own those companies. And as I told you, I recommend that you have exposure to both economies, because China is the second largest economy in the world today. Soon it will be the first. And it's not just about that. It's growing not at such a fast rate like, let's say, India today. But it doesn't matter. What matters is that the market in China is less correlated with the rest of the world. And also there's not so much investment yet from institutions, even from foreigners. So the market in China, it's mostly Chinese people buying stocks there. But in the long term, we expect more people from other countries are going to invest in China. Even though today it seems that this is going to be unlikely, people don't want to invest in China anymore. Believe me, things change like this. In 5 years, 10 years, people will invest in China. Things are always changing. And it's not just about investing in a particular country, it's about the sector, a company. This is how most investors unfortunately think. But what about this particular company, China Mobile? Why do I say this is the best stock in China? First of all, it is from the old economy, like we said, 70% owned by the Chinese government. So they have absolute control on the company. So the company itself, it is the largest network operator in the world. So they are just like AT&T, Verizon, these companies, but they are much bigger. When you look at these companies, you read the report, 970 million customers. It is not something you will see in any country. And their business goes beyond China. They also own Zong, which is the third largest network operator in Pakistan. And Pakistan also is a country with a big population. They own the largest network operator in Hong Kong. So I won't really say that they have a diversified business geographically, but it's more than just the Chinese market. What about the growth of the company? Can they acquire new customers? Actually, it is a little hard. There's a limited number of people on Earth, even if we reach 8 billion. So the growth of the company by number of customers is not going to be that much over the long term. It is something that we need to accept. But we need to also look at how the company is generating revenues. They are building 5G. They have an investment in a tower company there in China. So it's like American Tower, but it's in China. So they're building these 5G towers. They have other businesses, for example, services. So all of this is still bringing them revenue. Even though you look over the last 5 years, revenues have been growing by only about 1.3% a year. It doesn't look that much. But still I believe at the price at which the company is today, it is reasonable. So we should not really look at it like a gross stock. We are not going to put 20, 30 times earnings on the company, but actually we look at it like a value stock, like an established company. And this company, as I told you, they pay an 8% dividend yield. And the dividend is not that high because of the price is low. The dividend is high because they keep increasing their dividends every year. And they are aiming to pay 70% of their profits as dividends. This is something they can do. They are not going to lack any money because they do this. This is something that they can do, and they will do it. So if you invest in the company, you are sure to be paid a great dividends today. And 8% in Hong Kong, they don't have any withholding tax there. So 8% comes to you, and then you pay the taxes yourself. So depending on your country, I don't know how much you will pay, but you will actually get the 8%. So if you live in a country with no taxes, you get everything. So why invest in this company and not the competitors? There are two competitors, China Telecom and China Unicom. China Telecom compared to China Mobile, the main difference is China Telecom was more focused on fixed telephone. That's why the other one is called China Mobile. So to make the transition from fixed phones to mobile, it took them more time. And today the company is still lagging behind. So that's why I prefer China Mobile over China Telecom. What about China Unicom? It's growing faster. It's because they offer the best rates. So people who cannot really afford to use China Mobile, they will choose China Unicom. But it is also riskier. Not that the company will lose money or go bankrupt. It is also a company without any debt, but it is riskier, by which I mean it has lower margins. And even if it is growing today, doesn't mean they will be able to pay you dividends as China Mobile is doing. And whenever you invest in a company, there is something called the dividend factor. You always put more value on dividends because you know that this is cash that is actually coming to you compared to expecting the stock to grow. This is something that Benjamin Graham talks in security analysis. So based on all of this, on the dividend factor and everything else, I have calculated intrinsic value of China Mobile. You can read it on my research platform. If you're interested, you can have a 1-month free trial on the research platform. All my analysis are there and even my investing course for beginners. Intrinsic value I found is about $51 a share. 51 Hong Kong dollars a share. And you look at the stock today, it is about 50 Hong Kong dollars a share. So it is trading around its intrinsic value. It is trading under its book value. So I have been very conservative. I know there's a lot of risk in China. But also I have not used such a big discount rate as I would normally use for a Chinese company. Because as I told you, this company, there is no risk they go bankrupt. It is stable. So this is the only Chinese company I think we can compare it in a way like an American company, but not at 100%. We always have to take a bigger margin of safety. Even the auditing is done by Western firms, KPMG. So you know with a high probability that they're not forging their number, they're not lying to us. So in a way, it's strange that such a company is actually owned by the Chinese government. So based on all of this, I calculated the intrinsic value. It is fairly valued. So fairly valued without a margin of safety, which means I won't invest in the company today. But the dividends is really attractive. So if you want to invest because of the dividends, you have never invested in the company, this is something I would recommend you to. If you want, of course, I'm not telling you to invest in the company. It is in my portfolio for a reason because I like the company, but only for the dividends. If you're asking me about the price of the company, even if we include the dividends today, will I expect that we make 15% a year? No, I don't really expect 15% a year looking at how the Chinese market is today. If let's say investors' opinions change about China over the long term, let's say in 5 years, then of course multiples will increase on these stocks, including China Mobile. We can expect making more returns on the investment. But this is something, of course, that we don't know whether will happen or not. So it is a stock I will say that I like holding it. It is still a hold for me. I have enough exposure today in this company, in other Chinese companies. I won't be investing more, but this is not a company I can compare with, let's say, Process, where I expect high returns. It's just the same thing, but also the risk with China Mobile is lower. If you're interested to learn more about Process, I have made this video, so I will recommend you watch this video next. Have a nice day and goodbye.